Good morning, everybody, and welcome to this RIAA event, the Responsible Investment Benchmark Report Australia 2023. I'd like to start by acknowledging the traditional owners and custodians of lands that I'm on today. That's the Dja Dja Wurrung people of Central Victoria, and just pay my respects to their elders past and present for all the stewardship they've held over the lands that I'm on here, and really extend that acknowledgement to all the different lands from where people are calling in from today. And welcome to you all. Thanks very much for joining us here. These responsible investment benchmark reports, they really are kind of an important moment in time in measuring and mapping the size and the growth and the dynamics and the performance of this fast growing and burgeoning responsible investment and ESG sector across Australia and New Zealand. They're an exciting moment in time for RIAA each year. They perform such a foundational piece of research that now for 22 years has been mapping this industry as it has moved from a very small niche cottage industry subsector of the broader financial services sector to where we find ourselves, and where you're all well aware of where we find ourselves today, as really a really core part and consideration of professional investment industry and financial services industry across not just Australia, not just our region, but really globally. So again, today, really a big welcome to join us as we unveil this year's report that talks to that change and growth and dynamic in the industry. A huge thank you to our sponsors and partners who help us to put these bits of research on. They are really significant pieces of research, as many of you who have participated in them this year would be aware. It's a big survey that goes out. It takes a lot of work from our research manager, Juja, who you'll meet shortly, and a lot across the team. So a huge thanks to our partners, Australian Ethical Investment, T. Rowe Price and AXA Investment Managers, who have supported us in putting this on again for the 22nd year. And of course, EY, who are our research provider for this year and have been for the last few years helping us to deliver this research. So this is an exciting moment to kind of be mapping, and we're really keen to get into the findings of this year's report. You're all as well aware as we are of the position we really find ourselves in. This really, as I've said before, this really a sector that has stepped up, that is really part of a mainstream consideration of financial services, and a significant shifts underway right now, such as the increase in regulation and the focus of our regulators, of our policymakers, legislators, standard setters that are really starting to move to professionalize our sector. I think it's fair to say in the last couple of years, it's really moved from an opt-in part of financial services to very much embedded in compliance, in core risk management, across the sector. And so the data today already reflects that interesting shift and maturation of the sector we find ourselves in. It's a time where I think it's really evident that to sit still really means that you will fall behind as this industry rapidly evolves and matures and professionalizes. And so this kind of research that becomes such a strong foundation for us all to refer to look at, to understand what's really going on as this industry matures, is really a critical kind of input to that, and something that we think is really important for the whole sector to use, to refer to unpack. And today we'll have a chance to do that. So we're going to start with a run through of this year's results from our research manager, Dr. Juja Banhalmi-Zakar, and we're really pleased to have Juja with all her experience, deep experience in both academic and private sector in sustainable finance and ESG, who's again run our research this year and unpacked the survey. And then we're joined by a panel discussion who I'll introduce once we've had our initial results shared with us, to really sort of unpack this and understand the dynamics that we all see every day as we're working in the industry. How's that playing out? How does this data really help to kind of reinforce that and show something of a pathway as to where we're up to, but really importantly, where we're going next? So welcome. And with that, I'm going to hand over to Juja to run us through the results. So thank you, Juja.
Thanks, Simon. Good morning, everyone. It's my pleasure to present you with the findings of our 2023 Australian Responsible Investment Benchmark Report. First of all, I'd like to thank all the survey respondents Without you really, it's really difficult to get meaningful data and data that covers that significant portion of the market. So thank you for taking the time and providing your responses. Really, you'll see that a lot of the slides will be just about survey respondent responses. So we rely on that heavily. Secondly, I'd like to thank our research partners, Ernst & Young, as well as Lonergan, who put the online survey together this year. A lot of work has gone into it, and another year, another report, and another story to tell. This is my third report, and I thought for sure there won't be many surprises, but yet we are, there's going to be some real interesting pieces of information that I'll present today. I have about, I don't know, 15 to 20 minutes to do so. So the intention for me this morning is to not to give you like a comprehensive overview of the study, but rather I picked out little snippets from the study, mostly around our key findings. But if you're interested in any specific area, I encourage you to access the report. The report is available to download off the RIAA website. You don't have to be a member. It's available to anyone, and I'm always so pleased to announce that that's how we run things. So first of all, this slide just is a very, very meager representation of the immense developments that were happening in 2022. Our benchmark study always covers that 12-month period. So the prior year, 2022, we have really long tables in the report where we try to gather all the main movements, main policy developments throughout the world, as well as in the domestic market. So of course, there's a big climate change theme, there is a big regulatory theme, there is standards themes throughout and across around the world where most of our international but also domestic investment managers operate. So that provides us with a framework, the tables there in the report for you to have a look and like a quick guide really. So if you want to catch up on what's been going on and what might impact your work as a practitioner. And the next slide is the, this is sort of has become a standard slide in the research report. It kind of summarizes the whole methodology, the whole study in some way. We've got survey respondents, we've got desktop research respondents, we've got total market numbers on there all together. So this year's total market, according to the Australian Bureau of Statistics, is 3.6 trillion really. We had an immense research universe this year. The research universe is really all the investment managers, trust funds, et cetera, impact investors that we cover in the study. And that's at 3.3 trillion. So a huge bulk of the market we've covered. And the reason why we did that is because all of these organizations that are making up that research universe have outwardly made some sort of commitment to responsible investing, ESG, either by being RIAA members, Principles for Responsible Investment members, or having ESG or responsible investment policies publicly available on their website. So this is a phenomenal, we think, threshold or step up in the market that we see so many investment managers engaged in this. Okay, so within that, of course, the darker blue area covers the responsible investment assets under management. So this is a subset of the research universe and the entire market. And then within that, we have our responsible investment leaders that we'll announce towards the end of my presentation. So on the next slide is the comparison of the size of the total market over time, over the last 3 years, as well as the size of the responsible investment assets under management value. So we see that the total bar of the total market has actually decreased slightly from 2021 to 2022. And that's about, I believe, about a 40 billion decrease in managed funds market based on the ABS data. Consolidated and so forth. So we also see a decrease in the responsible investment assets under management. And this, you know, we spend a lot of time thinking about what are some of the causes, what are some of the reasons why we're seeing this. Is it a change in our approach, our methodology? We did change the scorecard slightly. We did change the leaders definition slightly. Is it a change because we have different number of leaders? Is it a change in the leaders themselves and what they're doing and what they're reporting? What about the market? Obviously, there is something going on there due to the sort of negative growth. Is it a change in responsible investment practices overall? And I think the truth is this is going to be a subject of discussion, I guess, an interesting discussion later on during the panel session. But I think it's a combination of all of these factors. Okay, so we do actually the number of leaders or those that contribute to this green bar has actually increased from 74 last year to 77. So you wouldn't think that the number is the key. Maybe those who are covered or are named in that responsible investor or responsible investment leader group. We did see a little bit of change in the values that survey respondents reported as their responsible investment coverage. So somebody who has reported, or organization reported something higher one year, or in the previous year in 2022 reported a lower number for whatever reason, and that could be market reason, that could be a whole raft of reasons. We didn't really ask about that during the survey, so we can only make some educated guesses. So that's, however, I think despite of a really challenging year in 2022 due to the slow growth globally in the economy, as well as some of the domestic interesting developments, it's still an encouraging sight to see that responsible investment market is holding strong. The other side, the flip side of this discussion is on the next slide, which talks about the performance of responsible investment funds. So this year we've changed the report slightly because the good news is we have so many RIAA certified products that we're able to present you with these results like we did as a trial last year. But this year we can come out and actually say that, look, we have substantial number of products covering these different asset classes or asset class categories, and we're able to present these on these data with confidence. So really what we see is that 1 year, we're up with that orange arrow, that 1 year performance is really where, well, it's actually negative across the board. So the benchmarks, basically the traditional market, are also had a very negative performance, and we can talk about interest rates and the impacts of a whole bunch of other market impacts. On the 3, 5, and 10-year periods, though, we see that RIAA certified funds are performing better than or on par with, by and large, with the benchmarks. So that's really encouraging, and that's I guess that's what we would have hoped to see, and it shows that these investments will hold on over the long term as we had anticipated. And I'll come back to this when we move along with the survey respondents, barriers, and to market, as well as what drives people into the market, because that medium and long-term performance seems to be gaining traction amongst practitioners. Moving on is a sort of a deeper dive into the responsible investment approaches. And what I mean by this is this categorization based on the GSIR or GSIA. So we still kept these categories. We basically look at responsible investment as taking shape in 7 different forms: corporate engagement, ESG integration, negative screening, norms-based, sustainability themed investing, positive screening, and impact investing. So what we see here, and I just use the arrows to point out some of the growth or the changes in this year. We see that corporate engagement actually took out first spot, but actually corporate engagement, ESG integration, and negative screening are all very, very close when it comes to assets under management coverage. And the reason is that these strategies tend to be applied across the entire fund as opposed to applied at the product level. So we collected information on that this year. as well in a bit more detail. So what we see is a huge growth in norms-based screening, which wasn't really typical in Australia in the past, but that's a really encouraging sign. Sustainability-themed investing over the last couple of years has really improved and is really a continuing trend, a very encouraging trend. And sustainability-themed investing means that investments are actually geared towards or are targeting certain themes in terms of the type of projects that they seek to support or activities that they seek to support. Impact investing, I always have an enthusiastic group of impact investors calling me about the benchmark report and wanting to know how impact investing is faring. And there's good news there to share, nearly a doubling in impact investing since 2021. So the next few slides, I'll go into each of these approaches in a little bit more detail, just to try to, again, there's more detail in the report, so I encourage you to have a look if there is something there that you're interested. A new question for this year was, which environmental or social issues did you as a survey respondent engage in 2022? So here we see climate change at 93%, human rights at 84%, diversity inclusion issues at 76%. So what this tells us is an immensely active and engaged investment management sector in Australia. And not only are these numbers like the 93 and 83 are really high, but the coverage, the diversity of issues that are being that basically questions are being asked about or information is being gathered on. So that's really encouraging. I think that's a question we'll keep on in the future, just so we can have some year-on-year comparison there. So corporate engagement and shareholder action, we also have a bunch of questions that ask about voting, as well as asking about reporting on activities and outcomes. RIAA is a strong advocate of transparency. We'd like to see you report on your corporate engagement and stewardship activities publicly. This is what we think is the golden standard, I suppose, and that's what we're measuring and what we're looking for. So we see reporting on activities and outcomes is staying at the moment at around just over 40%. Reporting on either on just the activities or outcomes is actually decreasing by 13%. And then there's also a larger group of no reporters in our research universe today. So considering our research universe grew to 272, or about 90 to 93% of the market, I think what that means is that there are a large group of investment managers in Australia that are just starting off on this practice on responsible investment, so the newcomers. And because we're looking at 2022 data, in order to be able to report on activities and outcomes, you do need a few years of data to be able to do that. So we would expect that proportion to decrease, the no reporting proportion, as new players come to understand the expectations for responsible investors is to actually report on outcomes and activities. The next responsible investment approach was ESG integration. So again, this is a strategy that is by and large applied across the entire fund in Australia. That's the practice. The ESG, overall ESG coverage increases. So those that were integrating ESG at a main asset class level or specific one or two asset classes are now actually rolling it out across their entire operation. So we see that trend continue over the last 3 years. Yet we still find this steady no ESG integration proportion of around 20 or so percent. This is kind of interesting, and I'd like to delve into that a little bit more in the future as to why that is. I think there's a large group of impact investors or perhaps boutique firms that have more of a sustainability or impact focus. So it is possible that that's what's happening here, that they're just picking a different strategy. ESG integration is not their main strategy, but perhaps other approaches or other strategies are. So that's kind of interesting for us to bear in mind as we move on with ESG integration. Next up, we have negative screening. So we have a couple of slides or a couple of figures in the report, and I pulled probably the most complicated one out. But really what I just wanted to tell you everything. So on the one side, we have negative screening, which overall has dropped for the first time. That's interesting on its own. The top exclusions by fund managers by AUM. So this is proportion of those who negatively screen. So for the first time, we can actually put numbers next to these topics. So we have 570 billion of assets under management currently screened against tobacco production, nuclear weapons at 353 billion. Fossil fuel related screens are actually 3 categories pulled together. So on the right hand side in the figure, you'll see 3 separate categories, but I just added them up here. This is mining, various maximum 10% exclusion and so forth. Those categories are included as well, but also power generation. So over $400 billion are actually screening against fossil fuels at the moment. Adult entertainment, human rights violations come after that as number 4 and number 5, but the magnitude, the difference there is huge. In comparison, when we look at the top issues that Australians want to avoid when investing, and this data comes from our consumer study, which we published in early 2022. This is a study that looks at 1,000 Australians and surveys 1,000 Australians, representative of the Australian population in terms of gender as well as age groups, and ask them a series of questions about their knowledge around ESG and responsible investment and so forth. So we pulled data from that report and just put it against what is actually being screened in Australia by the investment managers and what Australians actually want to avoid. So here we see that when we ask the general population, animal cruelty is a top issue of avoidance, human rights abuses, adult entertainment, environmental harm, and animal testing. So as we always find is that there isn't really a match, but I think things are getting a bit closer. I think the investment managers are listening, taking into account, this really important information that we publish there. Next up, we have a norms-based screening. So this is an area that grew tremendously. This is a strategy used fund and product-wide. Climate change norms have increased, which is the ones that I've highlighted with the orange arrow there. They're increasing in use or applicability. Indigenous people's rights is also increasing. I would think that maybe RIAA toolkit or the availability of tools that help investors rely or use norms to help them with the screening is regarded as quite useful. So that's encouraging. I think that's an emerging new approach that's being used in Australia now that we need to, consider seriously. And I encourage you to look into that if you or your organization don't have norms-based screens yet. Trends in sustainability themes investing up next, again, an area of growth overall, very encouraging. It is primarily a product-wide applied approach. So investment managers will have sustainability themed products. Top themes are climate change. I don't think any surprises there. About $83 billion worth of assets under management currently trying to target climate change related projects. Social impacts, waste management, zero waste. Then we have biodiversity, natural capital at 21 billion, green property at 20 billion. So again, this is the first time we're able to put these exact dollar values on there based on survey respondent provided data. So thank you to those, and gives us a real insight into which themes are currently being targeted. Again, so the second part of the bottom top 5 text is around top themes that Australian population seeks to support when investing. Climate change is on top there. This comes from our consumer study, but healthcare and medical products and sustainable water and health rivers are also there, which are not really, they're a little bit bundled in with biodiversity and natural capital, but not as explicitly, I think, as as the Australian population would seek to invest or support those types of projects. Next one is positive or best-in-class screening trends. Again, these applied mostly at the product level. What we have found are some of the top issues are more sustainable companies. $40 billion currently earmarked, I suppose, towards more sustainable companies as a screen. Now, this is basically, well, we included it as best of sector or ESG leaders. So you can think of this as the information that practitioners use to then be able to select the type of companies that will fall into their portfolios. So they're relying on a bit of external data on that, or some sort of ranking, or something to give them an indication that some companies are invested companies are better than others or at the top in terms of their sector. I see this as a bit of sophistication as well in terms of methods. So rather than just excluding entire sectors or activities, we see that there is a more careful, a more nuanced, I suppose, process behind selecting those invested companies. $30 billion towards sustainable water management use. We've got renewable energy, energy efficiency, green property, and human rights as being selected for a positive screening product. And last but not least, we've got impact investing trends. I spoke earlier that this is a near double from 30 billion to 59 billion since 2021. Bulk of it is still bonds, so green, social, impact, climate bonds. I also saw wellness bonds, so various other categories are emerging there. Encouragingly, 13 out of our 66 survey respondents actually have some sort of impact investment funds or bonds, which is really good, and probably a trend that we'll continue to monitor and hope that that continues as we move along. Conservation, environment, and agriculture, there's a huge interest in investments in that regard from the impact investing sector as well as the fixed interest area. Mental health and well-being, we had a bulk of other category. We weren't really able to ascertain what those were. Lifelong wellness, strong communities, I think those are more of the traditional impact investment themes. So we have a whole section in the report on impact investing, if that's what you're interested in. The lastly, I want to talk about a little bit on the survey respondent attitudes and towards responsible investing. So on the next slide, it's a summary slide. We actually have figures in the report on this. So this is just a summary of the percentages, key drivers, and key deterrents. So key drivers for responsible investing is demand from institutional investors, a growing interest by underlying investors, expectations of improved long-term performance. I think that's a big jump, so hence I colored it green. Growing acceptance that ESG factors impact financial performance. So we already saw the RIAA certified funds performance table there. So that aligns with this sort of perspective. Key deterrents, on the other hand, and performance is always at the top, somewhere at the top. So it has grown definitely over 2022. There is also mistrust, concern about greenwashing, a massive growth, I guess, from 23% in 2021 to 62%. No doubt asset cases, US ESG criticisms and so forth are probably playing a part in that. So some changes across the board, some major changes since last year, which was really, really interesting. And last but not least, I'd like to now present the responsible investment leaders and responsible investors in Australia for 2023. So congratulations to our responsible investment leaders. These, again, just to reiterate, we sent out emails to our members, and you can find more information about the change in methodology on our website. But basically, this is the top 20% of the research universe that we surveyed this year. Congratulations to them. And on the following slide, We'll have our new category of responsible investment leaders for 2023. These are all the organizations that met the threshold on our scorecard of 15 out of 20. Still a tremendously difficult feat, actually. But they just weren't in the top 20% of the research universe. So congratulations to them, and thank you to all for your responsible investment efforts in the past year.
Wonderful.
Simon,
Thank you,
over to you.
Zsuzsa. Thanks, Zsuzsa, for that thorough overview of the report. This report is rich in detail and takes quite a bit of digesting. And so I do really encourage you, you would have all hopefully received an email this morning linking to the report, and it's now live on our website as well. So please do, after this discussion, dive in to take a deeper look, because there's some really interesting and unusual dynamics at play in this year's report. And so I want to unpack that with the panel that I'm about to introduce. But this is a really fascinating story whereby we now see that across financial services and investment markets, those who have public commitments in place to responsible investment represent the vast majority. Effectively 93% of professionally managed funds now have some form of commitment in some way, shape or form. And 5 years ago, that may have been sufficient to call yourself a responsible investor. But in fact, over the last 5 years, we've really been lifting those standards and differentiating what leadership means. And leadership means being able to evidence and substantiate precisely what you're doing in responsible investment beyond just a public statement and commitment. So you're seeing that almost have a small drop-off this year compared to the overall market. So we want to unpack that a little bit. But effectively, this is a story of standards lifting, not just in Australia, but globally, as we're seeing the greater articulation of standards of expected practice, whether it's through greenwashing guidance from regulators, whether it's through ESG product labeling standards, whether it's through APRA requiring clearer delineation of what climate change risk management looks like, and even internationally more the evidence bases such as taxonomy is being developed and others. So this is really showing a market that's moving very rapidly and where it's leading to a clearer distinction and differentiation between leaders and the rest of the market. So the bar's lifting, and what was sufficient a couple of years ago is no longer sufficient today. So it's really showing that that shift over time. And interestingly, we're seeing, as I said, that slight drop off in that responsible investment AUM, that top line figure that we present here, the 1.3 trillion as being the total responsible investment assets under management. So I want to unpack that as well a little bit. And so let me welcome to join me on this panel. We've got Emma Hurd, who's the partner and Oceania partner for climate change and sustainability services at EY. Emma, thanks for joining us very much. And Leah Wills as well, who's the head of client relationships at Australian Ethical Investments. And I'm going to keep Zsuzsa here as well, because I kind of want some of Zsuzsa's input as well here as we go through. But what I might actually start with is, and Emma, if you don't mind me starting with you, just at a high level, kind of what's your read on this interesting stage we're at in the market's development right now that's being shown by these kind of quite nuanced results this year? Do you want to just give us a bit of a sense of where you think this industry is at as evidenced by this report?
Yeah, thanks, Simon. I think that's a great question and a really important place to start. I think there's a common theme coming through all of the different questions and all of the different data points as well, which is very much that it feels like we're at a bit of a reset point of time in the evolution of the responsible investment market. So, we've had a 2 decades, arguably more, in terms of the evolution of practice, in terms of articulating what are we measuring, what are we trying to achieve, what are the issues, what are the investment approaches, and how do we disclose performance. And we've had a whole period of, I guess you could say, experimentation in terms of what works for different types of investors and what the strategic goals and intended outcomes are as well. And we've also had, in the last 18 months in particular, this kind of period of increased maturity in the surrounding regulatory and mainstream market settings as well, in terms of regulator expectations plus broader kind of policy engagement, I guess you could say, around sustainable finance more broadly as well. So I think these kind of forces are combining, and you're seeing 2 things coming through. One of which is just doing anything doesn't make you a leader anymore. It once did, it does not anymore. Actually, the strength and the targeted approach of your ESG strategy is what will differentiate you, as well as breadth and coverage and completeness and scale and all those sorts of issues. So I think that's the number one issue. And then the second part that we're seeing as well is increasingly integrated thinking from investors themselves. So it's not just one fund or one portfolio or one product, which is the flagship sort of approach, but rather it's a whole of portfolio approach plus differentiated approaches for different funds or different strategies on different portfolios as well. So they're just, and on the one hand, a reset caused by increasing maturity, and on the other hand, increasing sophistication and integrated approaches to actually applying responsible investment strategies. And I guess we'll unpack all of that in terms of diving into some of the key data points as well.
Yeah, that's great, Emma. Thank you. And overall, we see this as a really healthy maturing of a sector, a change. And Leah, I'm really interested from your perspective, because it's almost like it's been hard to differentiate leading practice from just a commitment for quite a few years now, in a sense. So are we getting to a point where that almost, you could say, the gap's getting bigger, those who can really differentiate themselves and evidence themselves as leaders versus those just with sort of commitments and who are doing some of this? But I wonder what's your sort of takeaway when you look at this, Leah, at a higher, broader level?
Yeah, and I would applaud yourself and RIAA for taking a stance on the changing standards. And I think, you know, everything Emma said is absolutely true. That and the words that stood out for me were maturity. Every time I kept going through different aspects of the report, we aren't a cottage industry. You know, if there's over 90% of public commitments around RI, that's a great leap forward in terms of the industry and in terms of finance and investment managers. But I think it's really important to dig deeper on that, and the fact that consumers are still really concerned about greenwashing, that they want transparency around what they're investing in and the outcomes that they should expect out of a portfolio. It's really important that you have those pillars in place where you are actually differentiating between what is now mainstream, which I would call ESG, and what are the true sort of leaders in the responsible investing space. And, you know, things like making sure capital is being driven to the right industries, right companies, and having the effect in terms of real world impact, I think is really important. And that's where you see the key differentiator, I think, between the leaders and that RI space that you've identified, true RI space, as opposed to kind of mainstream ESG.
Thank you, Leah. And it's interesting that this is a similar story we've seen through other major markets over the last year. So we've seen Canadian equivalent benchmark report, their trends report, also do a bit of a correction. The US report a bit of a correction, and Europe maybe a few years earlier, a bit of that correction as well. So it's sort of this reset going on. I wonder with this sort of smaller RI assets under management, and at the same time we have seen a growth in the number of leaders and high performance responsible investors in that, from about 74 to 77 overall, but still a small reduction there. I wonder if we could just unpack a few of the contributing factors. And there's obviously 2022 calendar year was a tough one for responsible investment funds, often underweight energy resources stocks. But I wonder if there's an element of green hushing here, or we often sort of hear about actually people self-censoring a little bit and tempering what they're claiming is responsible investment. Emma, do you have a view on sort of some of those contributing factors?
Yeah, it's a really interesting one, the balance between the green hushing, greenwashing question. I mean, on the one hand, I kind of think, well, if you are lacking in confidence around your figures and you pull them from the market, that's slightly concerning, to be honest. I wonder if what we're actually seeing is a bit of a deeper interrogation of the reporting and the approaches that's actually occurring here. For two reasons. One, I think the legal department of most firms is suddenly extremely interested in disclosures around responsible investment, and that brings an additional layer of due diligence, internal sign-off, and often increasingly what we're seeing, secondary assurance of figures before they're published as well, which we haven't seen as much previously. That all takes time and also involves a bit of a reset. So I do I do wonder if we might see a jump next year as a whole bunch of figures are republished, restated under new management, so to speak, with greater, tighter controls and auditing around it in terms of expectations around both mandatory disclosures, but also as a result of this increased scrutiny. But I also think that there's the second part of it is also an element of thinking through, well, we've kind of been doing it for the last few years this way because we've been doing it for the last few years this way. But actually, what is it that we're trying to achieve here in terms of both our reporting, but also our ESG and our responsible investment strategy? So, you know, we are kind of seeing a number of firms thinking through what's our strategic intent here? Like, actually, where we really want to play in an increasingly noisy RI landscape? What's the strategy that's specific to us and our core value proposition, and how are we articulating that rather than just kind of you know, having the end result of many years of ad hoc disclosures that were the request of particular projects or outcomes as well. So again, I think that's thematic of the big reset in terms of tighter controls processes, but also a bit more thinking, a bit deeper thinking perhaps around purpose, intent, and strategic value generation as a result of the RI strategy as well.
Yeah, that's great. It'll be interesting to see whether there is that rebound next year. I guess in a sense, as we see moves such as by regulators to start defining what is sufficient standards to make claims. So we've seen that through ASIC and their greenwashing guidance. It kind of is building out the standards like as we move right now. And so I guess prior to that, there wasn't a regulated definition as to what's sufficient substantiation and evidence for making claims. So people will necessarily kind of go, okay, we now have them. And no doubt in another year, there'll be further articulation of what are expected standards as we see things flow through. And I think we're all learning, looking at Europe and the UK and other markets as well at the same time. So that's probably contributing there as well, I expect.
Yeah, I mean, and it's interesting, actually. I mean, even in the course of the year, I mean, ASIC has published more guidance on specific terminology, like what language should you use, which also is quite helpful, because it's like, oh, we're using that term, but we actually mean something different. You know, so I think there's a bit of a cleanup going on a number of fronts. But we also do know, and where the government has signalled in the Australian context, that they are going to publish more guidance on fund and product labelling, performance claims as well. Specifically, I think that will also help. So it does feel a little bit like we're in a bit of a transition period. And yeah, I mean, I would hope that we would see a big jump again next year. I suspect there's a number of firms who are kind of pulling back and reviewing their processes and thinking about the why, and then the how they disclose it, what numbers they're using, and the risk controls and internal processes they have around it as well. So that's definitely something that we're seeing right across the investment industry as well.
And a good point there that this isn't going to slow down. As we know, the Treasurer or Treasury will release shortly, within the next month, likely a discussion paper on their sustainable finance strategy that will help to go further again on probably some ESG product labeling type recommendations or moves. And if you only need to look at other developed markets to know what the next steps might be from a regulated or legislated perspective, and that is further guidance around fund definitions and classifications. And so this is not the time to take your eye off the ball, I guess, if you're operating in this space by any means. Leah, I'm really interested, contributing to that drop off as well. There's a performance piece here, right? So 2022 calendar year was one of those years where we saw some underperformance in the 1 year funds, pleasingly. And what we try to keep people's eye on is the medium to long term. But maybe can you help us unpack that a little bit? And even we're September now, so we're a good way into the next calendar year. It'd be good to hear how that's sort of playing out.
Yeah, and I think we sort of started the year with this rhetoric in the market around, you know, is ESG dead? Because we'd had such a strong track record of performance over sort of the past decade, with the rising momentum around RI and the type of investments that RI managers might hold. But then what we saw in 2022 is all managers were challenged. It was a broad economic backdrop of extremely, you know, inflationary pressures and interest rate hikes that we haven't seen in the the near term in terms of the economy. And so that challenged everyone. I would also say that active management got challenged through this period as valuations came under pressure, and any active management, whether you're a responsible investor or otherwise, you are going to have periods of volatility and underperformance because you are making those active calls based on what's going on around you in the market. But I guess there was that double whammy for responsible or ethical investors such as ourselves that have a real commitment to the climate emergency and not continuing to invest in fossil fuels in particular, but broadly across materials and resources. And we did see that obviously Ukraine, the flow-on effect was really the global energy crisis, but also a really strong spike in commodities and resources and mining services. So we suffered in the short term, along with a number of other RI managers. Pleasingly, we've seen the resource reversion, which you quite often do. It comes quite quickly and reverts quite quickly. And we've started to see that in the last quarter. We've also seen sort of better valuations, I guess, and buying opportunities in small caps, which had come under pressure through that period as well. So we've remained committed to our process and our approach, making sure that there's a rigorous ethical approach that we abide by, but also the rigorous investment approach. And we've seen over the last couple of months that we've been outperforming the indice, particularly in our Australian equities, which is our sort of flagship domestic active product.
It's interesting, and maybe at risk of taking us off script slightly. So, but in a time like this, a lot of people have asked us in the lead up to this report launch is what has happened to inflows into this sector. And there's an assumption that poor performance in a short term will lead to slower inflows or outflows. And it seems actually that those who select and opt into responsible funds are stickier, more loyal, and willing to ride out cycles. So the data from the benchmark report doesn't give us much indication of that. Certainly there's been other data. There was a big global piece by Morgan Stanley recently, but also we do a quarterly research reports on the flows and performance into certified products. And it seems to have held up really well. And I think that surprised some as a bit of a test for this sector. Any insights on that, Leah? Sorry to take you off script, but I'd love to just your observations.
Yeah. Sure. So I think the finance system came under pressure last year, and we certainly saw flows were lower, and I think that's reflected in the whole kind of industry numbers that you saw, not just the RI numbers. But look, we were really comfortable throughout the year. We saw that the sell-off that other active domestic equities funds were seeing maybe 12 or 18 months ago, we just didn't see the same in terms of our business. And then we've ended the financial year in a really strong position. So I guess we're fortunate we have SG that underpins our business as well, and that continues even through this period. And those funds need to be continued to be invested in a positive way. So we've been really pleased over the last 12 months in terms of where we ended the year, and probably in better shape than some other managers. The other thing I would say, adding to what you just said, Simon, around engagement and retention and things like that, we do a number of reports across the year outside of the benchmark report, and we have found that in surveying advisors in particular that are operating in the responsible investing space and providing that advice to clients do actually quote things like retention and engagement at higher levels. And anecdotally, when we're talking to those advisors that are the deep ethical advisors that have been in the industry doing this for a number of decades, it's a very different conversation. And these clients understand that there are going to be short-term fluctuations, just like any investment you would expect. But the long-term benefits, not just from financial returns and stability and security, but equally the purpose that they're investing with remains consistent over that time.
Yeah, great. Thank you. I want to move us on to this sort of a really dominant part of responsible investment in our market, somewhat uniquely, has sort of been ESG integration and stewardship. And it's always been really strong in Australia. And whereas if you looked at Europe traditionally, the really strongest approach would have been negative screening. And so, but it's an area where I think the report gives some indications of stepping up in how we, again, evidence and substantiate actually the activities underway through engagement, voting, stewardship activities. And there is data there like that we saw in that report, there's more of the managers surveyed have ESG integration and corporate engagement embedded across more of their asset classes. We're seeing holding up fairly well this sense that it's stewardship practices. People are reporting on their activities plus the outcomes. Always the really gnarly challenging thing is to report on outcomes from engagement. So perhaps that sort of advent of stewardship codes globally and the rising of that is really sort of pushing, I guess, a more mature approach to that. But I'm just interested, maybe Emma, if you want to kick us off, sort of just around engagement, what you're seeing, maybe even, I wonder how much of an Aussie specific kind of element there is here, considering the nature of an ASX, our economy, what it looks like in a net zero transition. You know, I'm interested in any observations on that.
Yeah, no, definitely. I mean, I think it's always interesting to see the toggling between the top three in terms of the investment approaches. And, you know, we can, sometimes you get very focused on which one won this year, I guess, to say, between corporate engagement, ESG integration and screening or negative screening. The thing that really struck me is how close they all are together, which sort of says to me that actually a lot of investors are thinking about which tool works best in which circumstances and as a function of what it is they're trying to achieve. So, you know, definitely the strong, you know, kind of similarities between response rates on integration and corporate engagement. You know, it feels like there's a relationship between those two, not just one, but both operating. And similarly, if you fail to get the outcomes that you achieve, then potentially divestment approaches come back into play as well as some thematic overlays in terms of moving away from different types of appetite for different types of stocks as well. So, I mean, I guess the closeness of the top three is interesting to me. The second thing, and this is slightly different, is on a topic perspective, the rise of biodiversity and nature-related issues. So we look at it in terms of biodiversity on its own, but natural capital is also in there. And I think in many ways, arguably, waste and circular economy is also benefiting from that boost of general nature focus, because I think it's, you know, we're sort of seeing across these different themes, there's a really strong kind of surge of interest in terms of understanding nature risk. Hardly surprising, particularly given the TNFD is launching its final report today as well. We've had a lot of momentum around that topic, and you know, both, but then obviously in the context of the continuing dominance of climate change related issues. So I think all of them speak to your question. The nature of the ASX as well is carbon intensive, high impact industries for the most part. If you're not directly contributing to some form of greenhouse gas emissions, you've still got nature risk exposure in your activities as well. So I think that increasing balance across those issues is really key. The last thing I wanted to comment on, which I think is quite a significant hallmark of the Australian economy, but also the Australian investment approach, is just the sheer importance of transition as a thematic. And this has a couple of elements, one of which is, you know, the negative screening. So very much that transitioning away from activities which have potential stranded asset risk or high carbon risk exposure, where there's less appetite to support, or there's less support from members or clients to continue investment in those industries. But the other part of it is transition within. So within key industry sectors, how are you allocating capital to help facilitate substantive decarbonisation or changing in the portfolio of assets or activities or income streams of a large diversified client to reduce their total emissions intensity and their total carbon exposure as well. So that transition thematic, I think, is so important in the Australian economic context. And you're seeing the importance of that reflected in everything from labelled sustainable finance products, investment strategies and taxonomies also all coming through in terms of how do we get better at putting more money into projects which deliver emission reductions sooner as well. So I think that kind of transition, the importance of that transition element is reflected in that toggling between the top three, but also what you tend to see by way of, I guess, the Aussie flavour of the responsible investment debate as well.
Yeah, it's fascinating. And I think you're right. And so often in Australia, you see managers who are using multiple strategies and they're all sort of done well. That's ultimately the most effective means. So we're seeing, for example, that rise in the data on commitments to Paris Agreement in that, in the norms-based screening. We also see quite high up in the top exclusions by fund managers, some fossil fuels, selected targeted fossil fuel exclusion are much more common. And then you're seeing in Australia these real live right now crunch points around key businesses that sit beside, on either side of that kind of transition divide. Can we transition some of those big gas stocks, for example, and whether you're in or out? And it's really interesting to see that. And I think hence that sort of need to then be able to articulate and defend why you would hold or not hold a particular stock. And we're seeing the scrutiny even on that. And we saw comments in the last week from ASIC around the need to evidence stewardship claims, how you're voting, etc., which is a really fascinating sort of live one for us. I think, Leah, your organisation does that, has nearly every one of these RI strategies at play. That interaction, I think, is really fascinating. I'm interested to hear your view on that. And then also, I think, then Emma also flagged that rise of the nature and biodiversity focus, which came through quite a few data points, actually. So I'd love to hear from you on those topics.
Yeah, sure. And so I think it's really what struck me was, how close those top three were, similar to Emma. And I do wonder if stewardship is sort of rolling off the back of ESG and this higher expectation from consumers, from regulators around stewardship. It has very much become, the tagline, I think, of the last 12 months for responsible investors. What I would say, though, is stewardship, it depends on how you consider stewardship. And so if it is engaging with the investee companies, how much of that is done behind closed doors, what are the results and impact of that engagement? And then I was really surprised out of it, or probably not surprised, that there's not as much reporting being done on that engagement as there is probably, what's reflected in terms of it being the top approach. And so I would suggest that what consumers and advisors would want to see is more reporting out of the engagement that companies are doing with their investees or investee companies. What I would also say is that Australian Ethical, we think of stewardship on a much broader basis. So it's not just who you invest with, but it's the engagement with government, with regulators, with industry associations that are governing the standards, and also market resolutions where you may not be invested, but you want to sort of get behind a particular cause in terms of maybe changing corporate behaviour, where you don't have that invested capital. We think of it as three pillars, and I think it's probably a good way to think about stewardship from a really leading point of view, and that is, how are you invested, how are you allocating your capital, and how are you engaging with those companies that you're invested with? But then outside of that, how are you engaging to actually create systems level change? And we have a few key focuses that we've been thinking about and acting on, and they are things like climate change, evidently the biggest issue, impacting RI, impacting the globe, but also, as we've alluded to, the transition that we have to undertake here as an economy, biodiversity, human rights, and also industrialised animal cruelty. So there's some of the big topics that we're not just looking at from the investments that we're making, but also how do we change at a system level some of the standards and outcomes and impact in those areas. And then I would say, it's not all, you can't always invest the way that you would like to. And so things like the foundation, where we actually have marquee grants that are really creating that bottom-up change that's required. So I think it's looking within the investments, but it's also looking outside of the investments and the impact that you can have.
Yeah, great. I meant to have mentioned at the start, and I can see some questions coming up and being answered. Juju, thank you. So please keep, and they're kind of informing some of our discussion here. And so we'll have time for more of those shortly. Juju, I just wanted to ask you on the stewardship observations, because you ran our stewardship study that we put out late last year. So we're really trying to kind of unpack what good practice looks like in stewardship. And I think move it from a broadly utilized term that's a little bit sort of amorphous to something that actually has process and practices and disclosures and escalations. And I'm interested, was there anything in the data you saw there around stewardship and engagement that sort of stood out as a shift and an evolution in that area?
Look, yeah, I mean, I think where we're at right now, and this goes back to the earlier discussion about lifting the bar and leadership, is looking at the scorecard, looking at all the questions that we put in the scorecard. We specifically strengthened the corporate engagement and stewardship category questions based on the stewardship study findings from the end of 2022, which really covered Australian and New Zealand practices. So basically, we now know what sort of questions, what stewardship would look like, you know, what leading practice, I suppose, in that regard would look like. So we had incorporated those, and I think it has become really difficult for any investment manager to achieve that 15 out of 20 score on the scorecard and be either a responsible investor or a leader without some type of outcomes reporting on a regular and systematic basis. So not just a one-off, we're looking for every couple of years, if not every year. We know that some investment managers have the resources, they're large, they have large groups and teams of ESG practitioners. But we, the way that we assess these, we actually want to take into consideration and not disadvantage some of the smaller organizations. But definitely public reporting of stewardship and corporate engagement is leading practice. That's what we want to see. That's what we want to strive for. I think the interesting thing from a practitioner perspective would be, how do you communicate that to the public? When the public seems to be still engaged with negative screening or avoiding investment. And I think that I think Australians as general are much better because of their compulsory investment in super funds. They're more interested in their investments and what the larger companies, super funds, and other investment managers are doing. But I think there is still a lack of understanding. So I think it'd be important for us as RIAA and RIAA members to think about how we're going to explain this complicated practice to those that don't really understand, and even down to the point of how we would teach it to those that have a finance background, that are on the investment committee side of things. So I think those are going to be the challenges, but I do see the trend of corporate engagement increasing, and its sophistication and the way that we communicate about it as a really encouraging practice, something that is bound to continue, and we need to bring along people with on this process, because they don't understand, or they just try to think binary. You either invest in something or you don't. So I think that's what we see. I think the codes, I was surprised that we don't have as many code signatories as I would have thought. New Zealand's sort of different, and this report is, of course, of Australia, but I would have thought that the UK stewardship or other stewardship codes would be more welcome and adopted, and I don't see that, even though I do think that those will provide organizations with the right framework to get started on those things. So I didn't, other than the reporting, which was encouraging, but that was actually the year before that we saw that. I didn't see a huge difference, I think, in terms of last year, 2021 and 2022, I should say.
And it's interesting to think how important the role of a stewardship code that's widely accepted and used in a market is in terms of shaping standards and performance. So we know in Australia there's an asset owners code, there's a FSC have some sort of minor stewardship code. Certainly in New Zealand, we've sort of worked with the market over there to build and set up a code in the last year. So that may shift that. I want to move us on a little bit to something that's dear to RIAA's heart, because our mission is really about responsible investment that aligns capital with a healthy and sustainable environment, society, and economy. And so we often look here for little indicators of, is capital actually shifting towards more sustainable assets and companies? And I think there's some early indicators that there's quite a significant upswing, albeit smaller, when we look across the data. So, for example, sustainability themed investing, those targeting more positive outcomes, assets and companies, has risen quite significantly. Positive themes, some step up there, and impact investing. And if you sort of think of that end of our responsible investment spectrum as those that are directing capital proactively towards sustainable assets and companies, there's probably another 100 billion step up this year, something in the order of that. So I'm sort of interested about unpacking that sustainability themed end of the market. and what's maybe driving that, or what is sort of needed to trigger that a little bit more? I don't know, Leah, if you had any thoughts on sort of that end of the market. And I note there's a question there as well about that sort of differentiation between sustainability versus impact, and how we're going at that sort of end of the spectrum of responsible investment.
Yeah, sure. So I would suggest that, I mean, evidently we label ourselves ethical, but we do have more sustainable, what we believe to be more sustainable investments in more forward-looking sectors and companies that we think are really contributing to a better future. And so that's how I would think about sustainability in terms of the major themes, that addressing the critical issues in society, that we need to address, climate being probably the most urgent. And I think that the growth in sustainability that we see year on year, I think is just a reflection. I think it's a reflection of two things: consumer demand, and consumers wanting to move towards more positive capital allocations rather than just negative exclusions. And anecdotally, we hear that. And I think that's reflected in those categories of concerns and issues. And every year I'm intrigued to see what consumers are searching for on the RIAA website, because I do think that's a real pulse check on what consumers are demanding or what they would like to see within their investments. And I think that there's a direct correlation between the sorts of things they're searching for and the positive nature of a sustainability themed option. I think impact goes one step further, and I think they're evidently trying to correct critical social issues, generally at a more community-based local level. But I think with the transition that we have to undertake in the next decade, if not couple of decades here in Australia, I think a lot of that impact investment, I think, will start to shift towards renewables and that transition. There's just not enough capital flowing through listed markets at the moment to be able to drive the transition that we require. So unlisted assets, VC, private equity, private credit, I think will be the domain of the next decade if we're ever going to be able to make the transition here in the Australian marketplace.
That's fascinating. I think we wouldn't disagree, and we're probably seeing. So this report obviously looks at all kinds of asset classes, institutional to retail funds. So it's a catch-all, and it doesn't really help us to kind of we unfortunately don't have the data kind of unpack where that sort of sits. But I suspect a lot of that sustainability thematic investing is in private or unlisted markets, and we certainly see evidence of a lot more funds in those asset classes coming to market, raising capital in the marketplace. So that's an interesting one. Emma, I wonder your reflection on this sort of discussion around sustainability, impact, sustainability themed, and effectively getting more capital flow into the types of assets we need to transition our economy.
Yeah, there's definitely a lot going on. Hey, it sort of feels like that. I mean, I guess the way I tend to think about it is putting together a few of the different data points again, is that it's almost like we're increasingly having, labeled sustainable finance products, which have a higher bar for definitions, greater expectations around measurable, disclosed impact outcomes, best in sector plus. And then you have unlabeled sustainable finance, which is integrated into your total portfolio management strategy, your risk identification, your corporate stewardship activities as a whole portfolio, or as a broader managing for risks, looking for opportunities in a more integrated way. So that top tier needs to keep getting more ambitious to pull up the rest of the market as well. So I guess that's one kind of element of it. And I'm saying that it's not just labeled funds or bust. It's actually, there's a couple of things going on here as well. The other thing which I think is really interesting is perhaps it's reflective, and just picking up on Lee's point as well, it's reflective of the increasing of opportunities, investable opportunities coming through of sufficient size and scale that are more investable from this cohort as well. So, we've kind of seen, we're not seeing fast enough the technologies coming through, the scaled opportunities coming through for the transition, but we are seeing a lifting of the size and scale of some of these opportunities to make them more accessible for this broader investment cohort as well. So I do wonder, again, as the market matures and more of these technologies come to market and hit scale, whether you'll also see more dollars explicitly allocated towards technologies and opportunities and activities that hit the right risk return profile for the institutional investor type audience as well. So that's one element of it as well. I also kind of think there's been a huge focus on standards and scaling the ambition in the standards which support or underpin impact funds or products as well. And I'm thinking here more around some of the green bonds, the social bonds type market as well. Just the specific criteria which underpin them continue to increase and become more ambitious as well, which is pulling through more dollars against those frameworks as well. So I guess there's a few things going on here, but definitely it feels like greater recognition of the differentiation between actual sustainable outcomes versus just good ESG risk management, more scale, and then the standards are all tightening and lifting all at the same time. So yeah, it's a really interesting space. Measuring outcomes continues to be really hard, but it's a problem which is there to be solved for sure.
Yeah, great. And a very useful distinction there too around sustainable labeled funds versus a broader kind of asset allocation model that will, through even ESG integration and stewardship and all of these tools, be starting to preference towards more sustainable assets without necessarily calling itself a sustainable fund. And we see that a lot with the big super funds, institutional investors, where whether it's through property allocations, through infrastructure allocations, where they probably won't be labeled that, but they'll be getting a higher weighting towards low carbon infrastructure assets, low greener property, for example. So there's definitely a risk of us missing quite a sizable chunk of capital there that is actually being deployed already, but not calling itself sustainable.
Yeah, I mean, tilting has an impact, but it's not labeled impact investment. But once that, you have sufficient amount of capital that's tilted into impact type activities, then you begin to be more in a position to actually then label it as impact type outcomes as well. So I think, the shift is on. And it's happening at different stages across different parts of the investment landscape. And I think as more of it moves into impact-oriented activities, you'll have more explicitly allocated towards impact-labeled funds, which sounds a bit pedantic, but it's all about the level of ambition and how much what you're doing with that capital and how you disclose the outcomes.
We love that level of pedantry when we work around certification of products and things. We go right into that, so we're okay with that here.
Can I just say something that interesting? I think the data that appears to be telling some sort of a coherent, story over the last couple of years, and that's around which directly impacts the ability to be able to make those decisions that you're investing and you're able to for sustainability outcomes, and you're able to measure and demonstrate those outcomes. So I think there is a story here of a growth in ESG professionals, the number of ESG professionals that are working in some of the mainstream investment management or asset owner super funds. So we see a movement of those people in there. Do they have the right skills? Do they need to be upskilled? So I think there is that demand as well. And there's a bit of lag, it seems. It takes time for everyone to be able to have the skills, the right skill set to be able to make those investments. And I know Australian Ethicals definitely has the experience and so forth, but many others don't. Some of the mainstream funds don't. And we also see a shift in practice in those more sustainable companies, investments, ESG leader investments. So there is a data need behind that to be able to make that call. And so when we asked survey respondents around the key information sources used, we saw huge growth in those ESG data, specific ESG data use, in addition to direct engagement with companies. So there is this hunger, I suspect, for data and for the right data, as we see more and more people who have ESG designated into their roles and are able to ask the right questions to move that capital in. So I would expect that growth into sustainable investments is to increase and continue with the help of those other external data providers.
No, definitely, and just sort of goes to the point of how important it's going to be, that standardization of disclosures and the climate-related disclosures and ISSB, and how much that will help as well in this kind of journey. we're kind of getting closer to the end there. I'm hoping we're ticking off on a few of those questions through some of the panel answers here. So I'm just keeping an eye on those as well. There's some interesting sort of data in this report, Leah, I wanted to bring you back to, and this kind of focus on greenwashing by our regulator. We can't have this conversation without talking about greenwashing, right? And so we've got to give it its time. We've seen, for example, in sort of deterrence, a key deterrence, mistrust or concern around greenwashing shooting up quite dramatically. I wonder then, and I think the question was raised from one of our attendees as well, like how much is that, that sort of ASIC focus and regulator focus really important that it's sort of lifting standards? Is that flowing through to be a deterrent and actually making consumers lack trust and faith in the products there? Or how are you sort of seeing that play out, and what do you think? And do you think that'll change over time again as well, I guess?
Yeah, I think it almost goes back to where Emma started the conversation, is this kind of turning point or maturity, and kind of like a teenager going through growing pains, right? So those growing pains are lifting standards, having more regulation, having more, as you say, having taxonomies and things that investors can really rely on. And so we would welcome the current, raft of global pressure, I guess, around standards, around labeling, around full disclosure, transparency. We would welcome any of that. And, it runs to the heart of what we do and have been doing for a number of decades. We think it's important that investors understand what they're investing in and what outcomes they should expect alongside the financial returns that they might be looking for. And I think it also comes back to a word that's been bandied around a little bit, is intentionality. The greenwashing and regulation really gets to the point of intentionality. What are you intending to do in your portfolio or produce in your portfolio? And then how can you actually report on the outcomes, and do they actually align? And so I think it's only a positive step for investors. And I think perhaps we're in this period of growing pains where there's more interest, more demand, more momentum in RI than ever before. And consumers are just looking for some guidance and direction around, how do I know what I'm getting? So I think, and there's been a lot of media, right? There's been a lot of headlines. So I think it's a period of growing pains that we will come out of, and hopefully what we're going through as an industry will give investors much more clarity.
Yeah, we'd agree with you, Leah. Yeah, clarity and confidence at the end of the day, that when they are choosing and opting into a fund that is labelled responsible or ethical or impactful, that actually they can have much greater faith and trust in getting what they're asking for. So I think that's really positive. There's an interesting question just popped up. There has been this sort of group of about 20% of those in the survey that for 3 years have not done anything on ESG integration, and Juja indicated some potential reasons for that. But there was a question around, do we see that potentially this survey does cover international funds as well as domestic, that some of the political ESG pushback element may be contributing to that, the sort of staying away from that? And I'm not sure whether you have any, Emma, whether you have any observations in this market of that playing out at all here.
Yeah, when on the greenwashing debate, I think it's important to remember that the decision not to disclose anything around your ESG or sustainability performance is a disclosure decision in an increasingly regulated market. So there's no safety in hiding information on strategy or performance, is my first comment. In terms of the politicization of the ESG factors, we tend to think of this as being a US problem, but and it is particularly acute in those markets at the moment in terms of being quite an aggressive campaign on ESG from a politicized perspective. But we're also seeing, we also have to remember that in the Australian market, in the Australian context, this is actually, we've had iterations of this debate of the politicization of investment strategies over the last few years as well. So, I think it's not something that this market is immune from, but it's certainly not something that we necessarily need to crash headlong into in terms of saddling up for the woke wars, in terms of thinking of this entirely through that lens. There are and always have been sound financial reasons for managing around these thematics and looking for performance-based outcomes in the context of ESG. And just back to that original question in the chat around, is it a deterrence? If you think about the mandatory disclosures that are coming in Australia and in almost every other major market where investors are particularly active, there's no hiding in non-disclosure for long. And if the regulators don't get you, then your clients are going to get you at the end of the day as well. So I think that issue is evolving as well. And there's definitely no safety in non-disclosure. Just to make that point a third time to really bring it home, Simon.
I know, I think it's great, and it was emphasised by ASIC, and it's so important. You know, there's not an option to just hide from this anymore, and I think that's why it's so critical that people are staying right up to speed with these developments, as hard as that sometimes is to stay up to speed with these developments, because there is so much going on. But it's the reason for that. Hopefully, a report like this helps to kind of keep people on top of things, but also indeed, you know, the work we do at RIAA every day with our members is about helping to build capability, stay on top of things, set the standards, things like our certification program, where we're looking at products every day and how they map, not just to the current standards in Australia, but also with a view to how they're mapping internationally, that evolution of standards, because again, in 2 years, things will be quite different. And I guess I want to sort of wrap this up with the final comments from each of you on what do you expect in the next 12 months? Where do you expect some changes to occur? And I wonder, just sort of a minute each or something as we bring this finally to a close. Could you, Leah, maybe start with a bit of what's your kind of the thoughts for the next 12 months in terms of the ongoing evolution in this sector?
First of all, I would like to say I hope we see the performance come back after a pretty tough 2022. We're starting to see the first signs of that, and I think that we will continue to. And I think on that note, the Australian economy is at such a critical point right now in terms of the transition and the capital that is required for the Australian economy transition, the change that companies have to undertake over the next decade. There is no doubt that this whole thematic will remain top of mind and will be key to driving market performance. And so being on the right side of that transition and making the right decisions around where to invest and where not to invest is going to be really critical, not just in the next 12 months, but over the coming decade. I think transparency is key. We haven't really talked a lot about it today. We've talked about engagement and stewardship and reporting. But one of the key things out of that report, which I continue to be surprised by year on year, is the portfolio holdings disclosure. Still only at 50%. We have it mandated in super now. If we are ever going to correct that the consumer concerns and confidence that we spoke about earlier, it's being fully transparent and being open and honest about where we're investing and why. So we already do that. We have done that for some time. I know that RIAA is demanding that. So we'd like to see more movement on that.
Yeah, couldn't agree more. Such a critical piece of building the confidence and trust and achieving any of these ends. So thanks for reiterating that. Emma, what's your sort of view of the next coming 12 months and how do things differ and evolve from here?
I mean, this is such an interesting space. It's always tricky to do any predicting with confidence. But I think there's a couple of drivers that are definitely coming through. I mean, the first is compliance and the second is competition. Compliance in the context of increasing scrutiny around disclosure, increasing scrutiny around product labeling, increasing enforcement action from ASIC with its new budgeted program. Increasing reporting requirements for a lot of investors and increasing expectations around the embedding of ESG factors into broader investor and financial regulatory settings as well. But also that, to Leah's point, that competition element is key. Competition for members, if you're a super fund, competition for clients, if you're a manager, competition for capital, if you're a company, and competition for sustainability performance in terms of those quality investments as well. So I think those two drivers are almost acting as a bit of a pincer maneuver in terms of pushing RI forward. If you forgive me, Simon, I would just make one final comment that 2023 will also be the first benchmark report without Simon O'Connor at the helm of RIAA. So I just wanted to quickly take a moment to acknowledge the huge contribution that you've made during your time of RIAA, and just thank you for all of the huge amount of work that you've put in over quite an extensive haul of time in terms of really pulling up RIAA and really driving, playing such a key role in driving forward responsible investment in Australia as well. So and globally. So just wanted to say a quick thank you as well for your huge role, and can't wait to see where you go and what you do next as well.
Thanks, Emma. Yeah. 10 of them I think I've been part of now. Yeah. And each one is really as difficult as the previous one. And I think that's because this industry is just changing and moving and evolving so fast. So thank you. That's great. Zsuzsa, any thoughts on your sort of, crystal ball gazing for the next 12 months and how things will continue to evolve?
I don't know. I'm more of a data person looking back, right? My hopes are that yeah, as Leah had said, that we see performance. I just don't. I see this as there's only one way to go, and that's I really also I'm hoping in my crystal ball that more survey respondents each year will give us a much better way, much better insight into the market, and I also would like to see us be much better at honoring the diversification of this market. So honoring those, the private equity, the private market as well in our research, so that we can capture and provide like a really holistic overview. So yeah, sustainability theme, positive impact all the way through, yeah, is my prediction. Continued
Wonderful.
growth.
That's great. And so as we draw this to a close, thanks so much, Emma, Leah, and Zsuzsa, of course, for all the work on this report. Do go and take this away and have a good dive right in as your sort of evening reading. There's a lot in there and a lot for us as an industry to learn from. Thanks so much for all the questions and interaction also there coming through to us. Hopefully we answered a lot of them. I think, the story here is that this sector is moving so fast and it's no longer an opt-in. It's a core part of financial services and what it is to be a good investment organization or financial services firm. So standing still really means going backwards now. And so keeping in touch with this big agenda that's sort of been laid out, and you've heard many pieces of it there, is essential right now. It's no longer an option. So staying engaged with groups like ourselves who work really hard with our members to not just help our members navigate this, but to actually shape this, to shape the policy, to shape the standards. We're working on a number of fronts right now, internationally and domestically, with Treasury, with ASIC, with our partners globally on some of the core definitions that underpin our sector. So there's a lot more to come. And of course, through certification, where it gets really into the nitty gritty and that pedantic level of how you define a product and making sure you're staying safe and helping consumers and not greenwashing through that work and delivering really high quality, responsible investment products. Because we know Australians, the vast majority of them want this. They want their retirement savings, their investments, their banking products to be invested in a way that is actually building a stronger future and avoiding harm. So we want to be able to deliver that. I think ultimately getting this right is critical right now. So the big transition we have ahead of us is so key. And so getting all of this right is really ensuring that we will be investing for that more sustainable economy and future. And so we want to work towards that end. So with that, I think I should wrap it up. We're right on time. A huge thanks again to our partners, EY. Thanks heaps to your work in bringing this together, along with Zsuzsa. And of course, our industry partners, Australian Ethical, Leah, and to your team. Thanks so much for all the support and assistance. To T. Rowe Price and the great work they're doing internationally and in our market, and to AXA Investment Managers as well for the great work and that they bring to our market. With that, we'll call it to a close. I hope everyone has a great day and enjoys reading the report. Look forward to seeing you all soon. Thank you, everybody.